19 credit cards. Not one, not five, but 19. And every single one of them is quietly bleeding you dry at a different rate. We're talking about a real situation where someone, let's call him Cannon, that was juggling balances spread across 19 accounts with annual percentage rates ranging from the low teens all the way up to nearly 35%. Now, think about that for a second. 35% is not an interest rate. It's a penalty for existing. That's the kind of number that makes your accountant cry into their spreadsheet at 2 in the morning. Here's how something like this happens. And it's not because Cannon was reckless. It's because the system is designed to make accumulation feel painless. You get a 0% promotional offer here, a store card with a sign-up bonus there, and before you know it, you've built yourself a financial Jenga tower with 19 blocks and wildly different weights. The real problem isn't the debt itself, it's the complexity multiplier that kicks in when you've got that many moving parts. When every card has a different rate, a different due date, and a different minimum payment, your brain shifts from strategy mode into survival mode. And here's where the psychology gets interesting, because most people in this situation aren't ignoring their debt, they're overwhelmed by it. There's actually a term for this in behavioral economics called decision fatigue, and it explains why Cannon might have been making the minimum payment on a 35% card while aggressively paying down a 13% one, simply because that bill showed up first. Financial advisors have been saying for decades that the avalanche method attacking highest interest first is mathematically superior. But studies consistently show that most people emotionally gravitate toward the snowball method, knocking out the smallest balances first. The irony is that feeling of progress on the small stuff can cost you thousands in high-rate interest, drag on the big stuff sitting in the background. Now, let's talk about what 19 accounts actually does to your negotiating power, because this is the part nobody warns you about. When you call one issuer to negotiate a rate reduction, and they pull your credit report showing 18 other open revolving accounts, the conversation changes, and not in your favor. Issuers look at utilization, account age, and payment history across all your lines. And a fragmented credit profile with many accounts signals risk, not responsibility. Consolidation, whether through a personal loan, a balance transfer card, or a debt management plan, immediately changes that optics game and puts you back in a position of leverage. History is actually really clear on this. Every major consumer debt cycle, from the credit card boom of the 1980s to the buy now, pay later explosion of the 2020s, ends the same way for people who don't have a strategic exit. The ones who survive and thrive aren't necessarily the ones who earned more, they're the ones who simplified faster. Here's a misconception we need to kill right now. Closing all your cards at once to simplify is not the move. Closing accounts reduces your available credit, spikes your utilization ratio, and can actually damage the credit score you'll need to qualify for a consolidation product with a decent rate. The practical play is a targeted, sequenced approach. Identify your 2 or 3 highest rate balances. Attack those with every available dollar while maintaining minimums elsewhere, and simultaneously explore whether a consolidation loan at a fixed rate makes the math work in your favor. You're not trying to win a sprint, you're trying to stop the bleeding strategically. Position size matters here too. Don't throw so much at debt repayment that you leave yourself with zero liquidity, because the moment an emergency hits and you have no cash, you're right back on that 35% card funding your car repair. Keep a small buffer, stay disciplined, and let the math do the heavy lifting over time. At the end of the day, the lesson Cannon's situation teaches all of us is that complexity is a silent tax. It costs you mentally, strategically, and financially every single month you let it persist. Discipline isn't about being perfect with money. It's about reducing the number of decisions you have to make correctly under pressure. Whether Cannon ends up with 2 cards or 0 cards at the end of this journey matters far less than the fact that he has a repeatable, emotionally detached system guiding each payoff decision going forward. Comfort with the outcome comes from trusting the process, not from predicting the result. And if you're sitting here realizing your own financial picture could use some restructuring, whether that's credit strategy, building equity through real estate, or finding the right lending partner to make it all work. Check out our links in the description below because we can help you get started.